What's up, guys? Welcome back to Roensch Capital Charts. Today we're taking a look at the incredibly popular S&P 500 ETF SPY, ticker symbol SPY, on a variety of time frames in anticipation of the next trading day, Monday, February 12th. Well, listen here. SPY on the last trading day, Friday, heading into this coming week, had one of its biggest days, I would argue, ever, breaking $500 a share as the S&P 500 broke and held 5,000. Of course, an all-time high here. So let's take a look here at this name, because there's going to be a lot to watch heading into this coming week. First, I want to zoom in just here on intraday and make you guys aware of some intraday movement that I myself, as a scalper, was paying very close attention to, and I know a lot of intraday traders were also watching. See this nice little rejection setup that was forming off of that 2 standard deviation band, the volume weighted average price band, right? You can see here, however, my only issue with this was that the channel had tightened down to like under 20 cents. When I say channel, I talk about this a lot with the group. By the way, if you guys want to get my personal scalp setup alerts every single trading day, take a look at the 4 membership options at that first link in the pinned comment. The price does go up over time, but get grandfathered in, and you'll stay at that rate for as long as you retain your membership. But looking here, these kind of rejection setups for me are highly interesting. Again, the only problem though, that channel between the 20 period EMA, right, that purple line is what I'm referring to when I say that, and that 2 standard deviation band from the volume weighted average price, that red line there. For me, if I'm trading SPY with a tighter ratio, which for me is oftentimes like a 20-cent stop and a 30-cent take profit, for example, if the channel is tightening down, I can't have that channel anything less than 25 cents. Otherwise, I have found over time through the data that it flips the edge negative. It flips it to a negative expected value. And it's very important, and we have to pay attention to these things. Because, I mean, realistically, if we're trading with negative expected value, we might as well not be trading. We're wasting our time. We're not making any money in the long term. So, nice setup, just a little too tight of a channel here. I thought I'd point that out to you guys. Let you know what I'm thinking intraday. So let's look at the 5-minute and look at the volume on the 5-minute. Okay, first of all, I want to take a look at this little pop that we had in pre-market. You see a nice little volume pop, of course, nothing in comparison to regular trading hours. Of course, that was right at 8:30 a.m. Eastern time, very common time to get data. But what we're really looking for here, okay, is big volume pops that correlate with moves that support our bias in the underlying market. Okay, for example, if you're a bull and you see a big bullish move upside, right, and then a fade, ideally you'd want to see as much volume as possible on that upside move and then as little volume as possible on the fade. Vice versa if you're a bear. Okay, now of course we saw a lot of volume here into the close, not unexpected, but we have been seeing some data glitches across the market these last couple of weeks. Remember that a lot of these brokers, they get their data from like only a couple of sources. So when there is a glitch, it'll show on multiple brokers. I think that's confusing to a lot of people, and I don't think a lot of people understand that. The data providers, it's almost like a monopoly over the market. There's only a few that like everybody gets their data from. So when there's a problem, it gets spread to a ridiculous degree. I don't think that's necessarily the case here. You know, under 4 million on a 5-minute candle is reasonable, but you know, we won't know for sure. But listen, as far as actually good data that we can pull from like obvious volume variation that correlate with moves, for me here on the 5-minute, it would be a force. And you know, I really don't see any great data that we can pull. So we might as well move on here and quit wasting our time on the 5-minute, okay? So now let's get a little more contextual heading into the day-to-day, like tomorrow, Monday, with the self-fulfilling prophecy indicators such as the 50 period, that white line, and the 200 period, that gray line. When I say self-fulfilling prophecy, I mean everybody's watching those. They're the most popular, so those are the ones that I want to be paying attention to, because you're going to get a lot of decision making around those levels. Okay, so here on the 30-minute, remember, we're always looking at a variety of time frames, but looking at each one specifically as one piece of the bigger picture. So here on the 30-minute, that 50 period is currently right around 499.50. So looking at that, if I'm a bull heading into tomorrow, if we see a backtest of that 50 period, first of all, I ideally would want to see it get above $500 a share, right? Just strengthen that level as much as possible. But if we see a backtest of that 50 period, that white line at all, if I'm a bull, I want to see that hold as support. Okay, the same way, if I'm a bear I want to see that break as hard as possible downside. And, also preferably if I'm a bear, break downside, retest, and then reclaim it as resistance and then fade off of that. Okay, let's move on here now to the 4-hour. You can see that the 4-hour, we've had this bigger upside move in SPY, the S&P. So that 50 period is going to take a little bit of time catching up. If we zoom in and then take a look at how far we are currently away from that 50 period, it's not going to be a tremendous move, but I mean, it's 1.5%. So that's either one very, very volatile day for the S&P, or at least a couple of bearish days to make a test of that 50 period. So listen, if I'm a bull, really what I want, I would prefer not to see a test of that, but if we do, obviously hold it as support, right? But if I'm a bull, really, I want to see this 50 period on the 4-hour cutting upside as hard as possible, getting some feet underneath this stock on the 4-hour chart, or the ETF, as quickly as possible, ideally above 500 as soon as we possibly can. And if I'm a bear here, of course, downside break of 5, and then break downside below the 50 period here, opening up a potential downside test, be a little bit of a bigger move, but down toward that 200 period. All right, let's look at the daily chart now. But first, what I want to do is just show you guys one factor that I'm paying very close attention to. Of course, very relevant here with SPY or the S&P. This is the 10-year Treasury yield. Just want to make sure you guys are aware of this. It's currently back above 4%, has been for a few days now. We briefly got below 4%. You can see on the right there. Okay, and when the market was in trouble and this thing was testing 5%, I kept saying that I want to see this fade as hard as possible back down toward 4. And I think if we were to get back down toward 4, aggressively trending toward 4, or getting below 4% on the 10-year Treasury yield, I think the market would really like that. We saw the 10-year Treasury yield start fading hard away from 5% back down toward 4, and that correlated pretty heavily with the market pumping, okay, and more like the long term here. And I think this is a factor now, because we're seeing we got down below 4, and we've been kind of hovering around there for a couple of months maybe. And ideally, I'd want to see this thing fade back down below 4%. And just give it up finally, because above 4%, I think the market has overlooked that. It's been willing to overlook that as of late with the bigger Fed story. But I just think below 4% here on the 10-year Treasury yield, since it has been so incredibly important in the last 18 to 24 months, I think would make this thing even a little bit more comfortable. Okay. But let's finish up here by looking at the daily. This is the most important chart, at least in my opinion. I think everyone in the world is watching SPY on the daily with the 50-day moving average and the 200-day moving average. That's all we need here. All right, maybe some implied volatility. We'll take a look. Listen here, the S&P 500 SPY on tomorrow, Monday. This is really simple. If I'm a bull, I'm thinking one thing. I don't necessarily need a ton of upside. But we just broke a huge, tremendous level. In this case, $500 a share on SPY. If I'm a bull, I'm thinking one thing. Upside or sideways. I don't care. Just hold 500. Hold 5,000 on the S&P. There's a little bit of variation between the two, so really I'm watching SPY. Just hold 500. Okay? If I'm a bear, I'm thinking one thing. 500 is a huge level, and holding that's going to be very encouraging to a lot of bulls. Giving that up would likely be discouraging to quite a few bulls and encouraging to quite a few bears. So what I'm looking at if I'm a bear here, always going to give both sides. Just fade below 5 as hard as we possibly can. Put some distance between the stock price or the ETF price and $500 a share to the downside. Put as much distance as possible. If I'm a bear, 500 is my enemy right now. Okay. Implied volatility, what are the options traders thinking in terms of comfort of the name right now? You can see here that we're sitting in the low to mid range. Remember, the lower that goes, the more potential opportunity it opens up for newer options buyers to experience some benefit from IV pump. Okay, if they buy when it's low and we end up seeing a return back toward equilibrium. And also the lower it goes, typically the more comfortable the options chain is seeing, quite literally, because this is how it's priced. The more comfortable the options chain is viewing the ETF at this time. Okay, the lower that implied volatility number goes. Let's finish up here by taking a look at the bias in the options chain here on SPY as we head into Monday here tomorrow. So we had 7.5 million total contracts. That's a pretty good sample size. 3.6 million were calls, 3.9 million were puts. So slight bearish bias on the overall call put ratio. But look here, this is where the secret is. The 0 to 20 delta, that very short term, the speculators, the gamblers, some might say, the very short term contracts. What's the bias in that short term? 933,000 calls, 1.97 million puts. So interestingly, here in the very short term, on average, again, there's no opinion here, this is just data. On average, the option traders are not trusting 500 in the short term, and we're seeing double the bearish short-term bias compared to the bullish short-term bias. If you look down here, the mid to long-term bias, however, the 61 to 80 delta range, that in the money, and the deep in the money, the 81 to 100 delta range, very much so leaning to the bullish side, which makes sense on the S&P. So overall, slight bearish bias. Mid-term and long-term, pretty heavy bullish bias, and short-term, very short-term, right? Pretty heavy bearish bias. Please, if you got value out of this video, subscribe to the channel. It's a brand new channel and it helps out tremendously. And I'll see you in the next one.